This module examines the concept of forecasting and its use in budgeting. In this module, we'll define what is a forecast, how to prepare data for use in forecasting, walk through several basic forecasting techniques, and end with how to evaluate the results. A forecast helps to predict the continuing budget baseline and helps to estimate the impact of changes. Forecasting is essential to budgeting and long-term planning. Even a new organization has to make estimates about its income and expenses for the next year. So too must a more mature organization that has years of experience in delivering services. A good forecast reduces uncertainty but will not eliminate it. Rather, compiling and analyzing data can provide managers with the tools to assess where there are financial risks that should be addressed in more detail. For example, forecasting future collections of a fee for testing services might reveal that the real inquiry should focus on why the number of clients served keeps falling and why there is a rising rate of non-payment of charges. The fact is, the more you know about what drives each budget element, the better you can predict their future values. Forecasts are about measuring accuracy. A forecast is only as good as it is accurate. Having said that, there is still value in an inaccurate forecast because it requires you to look more closely at what went wrong. That search process often yields better insights for use in the next forecast. You can always learn from past mistakes. Forecasting is only as good as the data used. Revenues and expenditures need to be looked at separately. It's best to look at each line item, but some of the smaller, less important items might be grouped together to simplify the task. What drives each line item revenue source? If there have been rate increases or changes in target groups, then the historical data series cannot be taken at face value. The rate increase may have increased revenues because the same number of clients paid more per visit. It's also possible that revenues may have decreased because the price increase was too high for some to pay, thus decreasing the number of clients. It's critical, therefore, to look at the historical data series in relation to changes in the underlying nature of the service and client environment. Also, be sure to identify any one-time or unusual items in the data series in order to assess if they might reoccur. Otherwise, it makes sense to go ahead and adjust the time series to minimize the influence of that one-time or unusual event. In other words, remove it. Needless to say, a clean data set is needed that takes into consideration the factors that drove the numbers. When we talk about clean, it means the data is complete, accurate, and has been adjusted for any unusual one-time occurrences. The goal is to understand each revenue and expenditure line item as best possible. Only then can a good forecast result. Budget forecasts are built on the history of each revenue and expenditure line item. But you also need to know client service history. What is the history of the number of clients served by various types of services performed? And what changes have occurred in the fees charged, or in the practices used in collecting past due amounts, or even in variations in service delivery methods? Perhaps there was a change in protocol to a single nurse giving 2 shots rather than having 2 different nurses giving 1 shot each. This service delivery change could impact the number of customers served, the labor costs for the nurses, and other features. Knowing, or more likely just remembering, these changes may help explain the pattern of the historical data series. There are external factors that influence local budgets. National macroeconomic variables such as interest rates, unemployment rates, and currency exchange rates can greatly influence your budget. The growth or decline of the general population, or more likely the target groups, can affect the number of clients served and therefore collections and costs. Obviously, the incidence of HIV impacts the work of a clinic devoted to HIV treatment. Local poverty makes it hard for individuals to pay for services. Public health indicators such as disease risks and outbreak projections will impact a health clinic and its budget forecast. This slide offers some links to sources of macroeconomic factors in Tanzania that might be used in the development of a forecast. It cannot be emphasized too much. Always document your work through detailed notes. These notes will become a useful tool when you need to forecast budget data in future years. Record all changes to the historical data series, especially any changes to deal with the unusual or one-time events that you had to smooth out of the data to produce a clean data series. Be consistent in the use of a fiscal year or a calendar year in recording the data. Document the forecast methodology used and why, even providing notations on why other methods were found not to be useful. All of this is to say that you want to document what you do so that you, or someone else, can recreate your work at a later period. Besides, we all forget things, so it's best to write it down. There are numerous techniques to use in forecasting, from the most naive to the very complicated. There's no best way, it simply depends. Let's look at some of the factors to consider. Accuracy is important, but there's no one method that assures accuracy of results. It might help to try different techniques to see which ones would have best forecasted past results using past data. That might give you more comfort going forward, assuming the past is the best predictor for the future. Using techniques that take too much time because you have to wait for information from some distant source, or a time-consuming search of archival records, may not be useful for small staff working on a time-sensitive budget process. There are some macroeconomic data sources that may be very beneficial, but cost too much money to rent or buy. You may have to go ahead without them. In what we do, mechanical forecasting is not likely to replace a human's judgment anytime soon. An Excel spreadsheet by itself can't answer the question, is that revenue assumption reasonable given what we know about the local community or the grant program? It takes a manager knowledgeable about the context of local health services. How would a spreadsheet interpret the local impact of decisions by higher levels of government or broader economic or demographic trends? Only you can do that, using your best judgment. Getting it right can save money. Correctly forecasting the amount of money to be received from the central government, donors, or paying customers will allow you to plan your workforce and resource use more effectively. That will save money, reducing the inclination to overstaff or purchase too much inventory. All of these factors point to the importance of having a skilled budget forecaster. Otherwise, mistakes can compound and make budget life difficult for the entire year. Now, what do you do when you apply different forecasting techniques, but each one produces a different result? A common rule to apply when two approaches are equally reliable is to go with the simplest technique. More sophisticated forecasting techniques do not necessarily lead to more confidence in the forecast results.